Welcome. As part of our series of topics about financial aid, today we're going to talk about the Public Service Loan Forgiveness Program, also known as PSLF. So what is PSLF? The Public Service Loan Forgiveness Program was created to support federal direct loan borrowers who work full-time in qualifying public service careers by forgiving the remaining loan balances left at the end of 10 years of making qualifying income-driven repayments on federal direct loans while working for a qualifying employer. So there are the 3 R's of qualifying. To qualify, you need to have the right type of loan, which is only federal direct loans, which are direct unsubsidized loans and direct Grad PLUS loans. You need to have the right type of repayment plan, which means you must repay your loan using an income-driven repayment plan. And you must have the right type of employment, which is full-time employment for a nonprofit or public sector employer. So, right types of loans: direct unsubsidized loans and direct Grad PLUS loans. Also, if you have other federal educational loans that have been consolidated into a federal direct loan. For the right type of repayment plan, that's an income-based repayment plan. And the monthly payment plan on an income-based repayment plan is determined based upon your adjusted gross income rather than the amount that you borrowed. For married couples, in most cases, the adjusted gross income will be the total AGI for both you and your partner. So here are some repayment examples using an income-driven repayment plan. So if your adjusted gross income were $75,000 per year, for example, the monthly repayment plan would be roughly $464 a month. If you were making $125,000, your monthly payment would be around $881 a month. Now, what is the right type of employment? To qualify, the employment must be full-time, and for either a U.S. federal, state, local, or tribal government, or for a 501c3 nonprofit. So how much could you expect to have forgiven at the end of 10 years? Well, the way that's determined is based upon the amount you underpaid your loan while working for a qualifying employer compared to how much you would have repaid based upon a standard 10-year fixed length repayment. So for example, if you had borrowed $100,000 initially, your estimated monthly repayment on a 10-year repayment plan would have been around $1,161 a month. If you did an income-driven repayment plan and you started out with a $75,000 adjusted gross income, your initial monthly payment would be around $464 a month. At the end of 10 years, if you had a 5% annual increase in income each year, you'd be repaying at a rate of $970 a month. Based upon that amount, at the end of 10 years, you would have forgiven around $47,000. Now, this amount is just an example. Your actual amount forgiven would vary dramatically depending upon what your initial starting income was and the amount you initially borrowed. So rule of thumb is that forgiveness is going to be substantially greater, the greater the difference between what you would have paid on a 10-year repayment plan and what you actually end up initially repaying on an income-driven repayment plan. If you want additional information, a couple of great resources are studentaid.gov. There's a whole section on public service that talks about all the different requirements to qualify for PSLF. They also have what's called a PSLF help tool, which you can find at studentaid.gov/PSLF. You're certainly welcome to contact our office as well. And our website also has a lot of useful information. Thank you very much for participating in this session. We encourage you to watch our other relevant topics.